All right, let's get right into it. The whole world, and I mean everyone, from the big funds down to individual traders, is just piling into this AI trade. The story seems simple, right? Buy the future. But what if the biggest opportunity right now isn't what to buy, but what to sell? Today, we're going to flip that script. We're looking at the other side of the AI coin, the trade that most people are completely missing, how to spot and short the old school software companies, the zombies that this new AI wave is about to make totally obsolete. This is all about avoiding a brutal truth that, honestly, 90% of investors learn the hard way. Buying the dip on a dying company isn't a savvy move, it's just, well, it's how you lose your shirt. And this right here, this is the most important question you can ask. It's a call for what investors call second-level thinking. See, first-level thinking is easy, it's superficial. It's just, hey, AI is going to be huge, so I should buy AI stocks. Makes sense. But second-level thinking goes deeper. It asks, okay, and then what? What happens next? What are the domino effects? It forces you to think about the fact that for every massive winner a new technology creates, every Amazon, every Google, it also leaves behind a graveyard of losers, these forgotten giants that just couldn't keep up. And look, let's be totally clear. This boom is very, very real. The demand is just insane. I mean, we just saw NVIDIA's market cap blow past $3.3 times trillion dollars. For a moment there, it was the most valuable company on the entire planet. This isn't just a bunch of hype. It's a valuation that's being driven by this crazy global hunger for the chips that power this whole revolution. So the market isn't wrong that AI is a huge deal, but it might be dangerously focused, staring so hard at the winners that it's completely ignoring the collateral damage happening right next door. So here's the battlefield. You have to understand this conflict. On one side, you've got the AI natives. The OpenAIs, the Anthropics, the new guys who are building the world's next great infrastructure from the ground up. Then, on the other side, you have the legacy software giants. And these are companies that have had a great run, years, sometimes decades, of just dominating their space. But a lot of them have this critical weakness, a high labor-to-revenue ratio. Basically, their products need armies of people to build them, to sell them, and to keep them running. Think about sectors like cybersecurity or HR tech, where so many platforms rely on a ton of manual work or human analysis. Well, these are just prime targets for leaner, smarter, AI-powered competitors who can do the exact same job faster, cheaper, and with way, way fewer people. But this isn't just about some friendly competition. This is about a fundamental force of economics that an economist named Joseph Schumpeter called creative destruction. And the idea is that real progress, real innovation is always disruptive. These new technologies don't just add on to the old way of doing things, they completely shatter it. They make existing business models, and sometimes entire companies, totally irrelevant. It's a process that creates a new class of winners while absolutely destroying the old guard. It's really the engine of capitalism. And right now, that engine is firing on all cylinders in the software industry. Okay, so if we buy into the idea that this creative destruction is coming for the software world, the next question is pretty obvious. How do we spot the victims before everybody else does? How do we identify these so-called zombie companies, the ones that are basically the walking dead, but their stock prices just haven't gotten the memo yet? Let's break down the warning signs. The number one danger is what we call obsolescence risk, and we have seen this movie play out so many times. Kodak actually invented the digital camera, but then buried the tech because they wanted to protect their film business. A fatal mistake. Blockbuster had the chance to buy Netflix for just $50 million and literally laughed them out of the office. You see, these weren't just bad luck, they were complete failures of imagination. They couldn't see that the world was fundamentally changing right under their feet. The big question we have to ask ourselves today is, which software companies are making those exact same mistakes right now? Okay, here's a practical checklist you can use to spot these potential zombies. First up, is the business model vulnerable? Like we talked about, a high labor-to-revenue ratio is a massive red flag. Is their product something a large language model could pretty much replicate or just make totally unnecessary? Second, what about the valuation? Is it just extreme? Does it price in decades of perfect growth with zero room for error? Third, you gotta look at the numbers. Are earnings and sales already starting to flatten out or even decline as new, scrappier competitors jump into the ring? Fourth and fifth kind of go together. Are they spending a ton of money on capital expenses just to stay afloat, basically patching leaks in a sinking ship? And finally, the ultimate red flag, an insolvent balance sheet where their liabilities are actually greater than their assets. That's a company that's basically on life support. And this is a perfect example of that valuation risk. At one point, the data analytics firm Palantir was trading at a price-to-sales ratio of 110. To give you some context, a ratio over 10 is often considered pretty expensive for a software company, so 110 is just out of this world.
A valuation that high means the market is expecting absolute perfection. But now you hear reports that these newer, more agile AI companies like Anthropic are eating their lunch, winning contracts, and showing off better tech. So it's really no surprise that the famous Big Short investor, Michael Burry, a guy known for his deep dives into overvalued assets, has gone after this stock as a short multiple times. When a specialist in finding bubbles is betting against you, you should probably pay attention. Okay, now before we just go all in shorting the old guys, it's probably smart to take a step back and look at the AI boom itself with a skeptical eye. Is all of this crazy growth actually as real and sustainable as it looks? Because if there are cracks in the foundation, then the whole thing, not just the legacy companies, but maybe even some of the new winners, could be in trouble. This is really fascinating. Some analysts have pointed out this really concerning thing called a circular financing loop. So here's how it works. A tech giant, let's say Microsoft, invests billions in a startup like OpenAI. Then OpenAI turns right around and uses a huge slice of that same money to buy cloud computing services from, yep, you guessed it, Microsoft's Azure. So on paper, for the tech giant, it looks like this massive organic revenue boost. But in reality, some of that cash is just moving from one pocket to the other. Now, it's not illegal or anything, but it really raises some serious questions about how real and sustainable that growth is, and it feels uncomfortably similar to the vendor financing tricks that were everywhere right before the dot-com bubble burst. All right, so now that we're armed with this knowledge, we know the targets, we know the warning signs, and we know about the potential wobbliness in the market. How does somebody actually put together a short trade? This isn't about just blindly betting against a company you don't like. It takes a really disciplined, systematic approach. A professional short trade is always built on 4 pillars. First, you identify your weak target using fundamental analysis. That's the whole zombie checklist we just ran through. Second, you use technical analysis to figure out your entry price. You definitely don't want to short a stock that's still shooting for the moon. Third, you set a realistic profit target. And fourth, and I really cannot stress this enough, you set a clear exit point. A stop loss is not optional when you're shorting. It is your #1 defense. Because a stock can, in theory, go up forever, which means your potential losses are unlimited if you don't have one. Let's dig a little deeper into those fundamentals. The perfect short candidate doesn't just exist in a bubble. You want the wind at your back, which means you're ideally shorting in a weak overall market, and even better, a weak tech or software sector. The company itself obviously should have weak fundamentals. You can screen for specific things. An enterprise value to EBITDA ratio over 20 is a sign of a really expensive valuation. And the ultimate sign of financial distress is negative shareholder equity. This literally means that if the company sold everything it owned and paid off all its debts, there would be zero left for the shareholders. It's technically insolvent. So once you've found your fundamentally weak company, you've got to time your entry. And this is where technical analysis comes into play. You're looking for a stock that's already in a clear downtrend. You're not trying to be a hero and catch a falling knife. You want it to be trading below a key resistance level. That's a price on the chart where sellers have consistently shown up and pushed the price down. Keep an eye out for negative sector rotation, which is just a fancy way of saying big money is flowing out of tech. And finally, you can look for specific bearish signals. Things like a MACD or a moving average crossover can confirm that downward momentum is building, and another one called bearish RSI divergence can signal that a stock's recent price gains are running out of steam and a reversal might be just around the corner. Now, if all of this feels a little bit abstract, let's bring it back down to earth with a very real, very painful history lesson. Because what we're talking about today isn't some brand new idea. We have seen this exact pattern, a revolutionary new technology, crazy high valuations, and total market mania play out before. Between the years 2000 and 2002, the Nasdaq fell by nearly 80%. Just let that number sink in for a second. 80%. Trillions of dollars of wealth just gone. Now, the internet was absolutely a world-changing technology, just like AI is today. But that didn't stop a catastrophic market crash that wiped out thousands of companies like Tets.com and Webvan, and it absolutely destroyed the retirement savings of a whole generation of investors. The promise of the technology does not guarantee the success of every company playing in that sandbox. The parallels between then and now are honestly pretty spooky. Back then, the big technology was the internet. Today, it's generative AI. The market mood in both cases can only be described as irrational exuberance. In the dot-com era, about 36% of publicly traded tech companies were unprofitable. Today, we have this massive ecosystem of really highly valued, but also highly unprofitable private unicorns that are being propped up by venture capital.
Now, it's not a perfect one-to-one comparison, sure. Today's big tech companies have much healthier balance sheets than the giants of 2000. But the core pattern of hype, extreme valuations, and a tidal wave of cash chasing just a handful of ideas, well, that should be a serious warning sign for all of us. So, after all that, what's the verdict? What does this mean for you? We've talked about the coming wave of creative destruction, we've laid out a checklist for spotting these corporate zombies, and we've looked at the echoes of market history. It really all points to one thing: the need for a different way of thinking. You have to be a contrarian. This quote from one of our sources is pretty blunt, but man, it really captures the whole idea. In times of total market mania, the market acts like a herd of sheep, right? All of them just running like crazy in the same direction. During this AI gold rush, they're all stampeding towards the exact same handful of stocks. The contrarian investor knows that's often where most danger is. The real opportunities, the ones with asymmetric payoffs, are found by looking where nobody else is looking. And sometimes that means betting against the herd right before it runs itself off a cliff. So I'm going to leave you with this one final thought. The AI gold rush is absolutely here, and everybody is focused on buying the picks and shovels, the NVIDIAs, the infrastructure companies. But that's first-level thinking. Second-level thinking demands that we ask the next question. While the whole world is buying the tools for the gold rush, who is out there identifying and selling short the claims on the mines that are about to run empty? Finding those obsolete, overvalued, and soon-to-be-forgotten companies, that is the real contrarian trade.